The number is $350 trillion. Not billion, not trillion, $350 trillion. That is the total value of financial assets currently held in custody in the traditional fiat system. And according to the people who actually run that system, the executives at S&P Global, the DTCC, Franklin Templeton, Fidelity, every single dollar of it is in the process of moving onto blockchain rails. Not someday, not theoretically, right now. With regulatory approvals already secured, with partnerships already signed, with infrastructure already being tested and deployed in live environments. And while the crypto crowd has been obsessing over price charts and waiting for the next catalyst headline, something has been happening quietly in the background that most retail investors have completely missed. The actual plumbing of Wall Street, the clearinghouses, the settlement networks, the core banking infrastructure that processes hundreds of trillions of dollars every year, is being rewired. And the XRP ledger is documented, by name, in the blueprints. Today I'm going to show you exactly what has been assembled, who is behind it, and why the math that emerges from connecting these dots is unlike anything I have presented on this channel before. Welcome back. I'm the calm analyst. No hype, no panic, just the structure. Let's pull back the curtain. Let's start with what the people running the traditional financial system are actually saying, because this is where I need you to pay close attention. These are not crypto advocates. These are not XRP maximalists. These are the executives who run the institutions that custody the world's wealth. An S&P Global executive stated publicly that up to $1.5 quadrillion across traditional markets could eventually be tokenized on-chain. The DTCC's director said over $100 trillion is already targeted for digitization and called the opportunity humongous. Franklin Templeton's leadership said most liquid assets will find their way on-chain, that once an asset is tokenized and lives on blockchain rails, it is simply a better form factor that can move 24/7, be used as collateral, and plug into programmable investment portfolios in ways traditional securities cannot. One participant put the total addressable market at $350 trillion. Another said it is all global investors on the planet with internet access. Another said over 2/3 of the world's assets will eventually be tokenized. These are not projections from a white paper. These are the people who run the machinery of global finance telling you, on record, that the machinery is being replaced. Now here's the question that retail investors are not asking loudly enough. When $350 trillion in assets moves onto blockchain rails, which rails are they going to use? That is the only question that matters. And the answer is not being announced at crypto conferences. It is being quietly documented in patent filings, regulatory notices, and infrastructure announcements that almost nobody is connecting into a single picture, until today. Let's do the math that the crowd ignores. Because once you run these numbers, the picture that emerges is not ambiguous. The DTCC's director stated on record that their aspiration is to eventually tokenize all $100 trillion of DTCC-held assets. They have already received their no-action letter, meaning regulatory approval to move forward. They are planning to launch services for participants in the second half of this year, and they have stated explicitly that they are partnering with multiple Layer 1 blockchains and Layer 2 derivatives of those chains to allow participants to move assets freely across networks. She didn't name the chains by name. She was deliberately careful about that. But she didn't need to, because the DTCC's own patent filing from March 2025 names them. Inside that filing, describing digital liquidity tokens that represent market-making relationships between assets on distributed ledgers, the routing example on page 16 shows a transfer from a node on Stellar's system to a node on Ripple's system. Ripple's network is named explicitly as one of the ledger systems in the bridge routing graph. It is documented infrastructure. It is pre-approved plumbing. And the DTCC has already added Hidden Road Partners, a firm Ripple acquired, to its back-end infrastructure. Hidden Road is now a formal connection point between the XRP ledger and the DTCC's settlement network. The pipe is not being proposed. It is already installed. Now look at transaction cost, because this is where the XRP ledger's structural advantage becomes mathematically impossible to argue against. 1 million transactions on Solana cost approximately $2,500. On Avalanche, $29. On Tron, somewhere between $600 and $26,000, depending on congestion. On the XRP ledger, the cost for 1 million transactions is roughly $10. $10 for a million transactions. That is why the XRP ledger wasn't even included in that cost comparison chart, because the number was so low it looked like an error. But it is not an error, it is the design. And it is the reason institutions building infrastructure that will process trillions in annual volume are not indifferent to which chain they use. At that scale, cost efficiency is not a preference, it is a structural requirement. The OCC, the Fed, and the FDIC have now issued a joint announcement confirming that every U.S. bank can hold tokenized securities on their balance sheets with zero regulatory penalty. The tokens can live on public blockchains. The same rules apply. Financial derivatives linked to tokenized assets are treated identically to traditional derivatives. The regulatory uncertainty that kept the largest pools of capital on the sidelines has been removed. The starting gun has been fired. Now let's stack the institutional evidence, because the DTCC patent is just one layer of this. TCS Quartz Gateway is a capital markets platform built on TCS Bank's infrastructure, the core banking system that powers two of the world's largest banking implementations. The State Bank of India alone processes over 400 million transactions per day on this network. TCS Bank's capital market solutions record 10 million trades per day at peak, covering approximately $40 trillion in securities across more than 100 countries. And inside the TCS Quartz Gateway flowchart, Ripple is documented as a public blockchain platform in the network architecture. Think about what that means. The infrastructure that processes $40 trillion in securities annually across more than 100 countries has Ripple mapped into its architecture as a settlement layer. That is not a partnership announcement. That is an infrastructure diagram. Those diagrams are built by engineers, not marketing teams. Engineers put in what actually works. Then look at Japan. Tokyo-based VTUP has officially launched a next-generation trade finance platform on the XRP ledger, designed to digitize lines of credit and settle global bank payments in seconds instead of days. The system allows importers, exporters, and banks to lock funds in XRPL escrow and settle instantly once conditions are met, replacing manual paperwork processes that currently take days to weeks. Global trade finance moves approximately $9 to $10 trillion every year. If just 1% of that volume shifts to the XRP ledger, that is roughly $90 to $100 billion in annual transaction flow through the network. 1%, not 10, not 50. 1% of a single use case, trade finance, generates $100 billion in volume on the XRP ledger annually. Now add Ripple's acquisition of G Treasury, which already processes $16 trillion in annual payment volumes across 1,000 corporate clients in 160 countries. Now add the MasterCard partnership piloting RLUSD settlement on the XRP ledger for card transactions. Now add the on-demand liquidity network already operating in cross-border payment corridors across dozens of countries. Start adding $100 billion from trade finance, $16 trillion from G Treasury, growing ODL corridor volume, MasterCard settlement flow, DTCC tokenization infrastructure, and you begin to understand why even fractional capture of these markets represents a use case for the XRP ledger, unlike anything it has processed before. Brad Garlinghouse was in the room at the Bank for International Settlements, alongside Christine Lagarde and central bankers from around the world. That was in 2019. The seeds planted in that room are now growing into the infrastructure announcements we are seeing today. That meeting did not happen because Ripple was an interesting startup. It happened because the people who run the global financial system were already having the conversation about what the rails of the future would look like, and Ripple was at the table. Now let me bring this to the regulatory dimension, because the regulatory picture has shifted dramatically, and most retail investors have not fully processed what that shift means structurally. The joint OCC, Fed, and FDIC announcement is not a small development. It is the removal of the last major regulatory barrier between traditional institutional capital and on-chain assets. JP Morgan was not afraid of blockchain. Goldman Sachs was not afraid of tokenization. They were afraid of regulatory uncertainty, the risk that a compliance officer would flag their blockchain holdings as a liability. That risk has now been formally eliminated by the three most important banking regulators in the United States acting simultaneously. The DTCC has its no action letter. The regulatory gates are open. The participants who have been waiting, pension funds, sovereign wealth funds, asset managers, custodian banks, now have explicit permission to proceed. The question is no longer whether they will move assets onto blockchain rails. The question is how fast and through which infrastructure. And the XRP ledger's position, documented in DTCC patents, integrated through Hidden Road, mapped into TCS Quartz gateway architecture, running RLUSD as a regulated stablecoin settlement asset, partnered with MasterCard, and operating at a cost of $10 per million transactions, is not a candidate for that infrastructure. It is already in the blueprint. Here is where I want to address the bear case directly, because this is a channel built on rational analysis, not one-sided advocacy. The XRP ledger is ranked fourth currently for real-world asset tokenization activity. Ethereum holds the dominant position with approximately 60% of real-world assets currently built on its network. The developer ecosystem depth, the institutional familiarity with EVM tooling, and the sheer volume of existing deployments on Ethereum give it a structural lead in the tokenization race that cannot be dismissed. Stellar is also named in the DTCC patent alongside Ripple. Bitcoin and Ethereum appear in the TCS Quartz gateway architecture. This is not a winner-take-all outcome. The DTCC director said explicitly they are partnering with multiple Layer 1 chains precisely because different assets and use cases will settle on different networks. So the question is not whether XRP wins exclusively. The question is what percentage of a market, measured in the hundreds of trillions, does the XRP ledger capture? And what does even a small percentage mean for an asset with a fixed supply of 100 billion tokens? S&P Global's executive put the eventual tokenizable market at 1.5 quadrillion. The DTCC is targeting 100 trillion in assets. One participant said, $350 trillion is the total size that has to move. Even a fraction of 1% of those flows settling through the XRP ledger represents transaction volumes and liquidity demand that dwarf the network's entire current history. And unlike Ethereum, where the architecture is older, the fees are more volatile, and the scalability debates are ongoing, the XRP ledger's cost and speed profile was specifically engineered for high-volume financial settlement. That is not a coincidence. That is a design choice that is now being validated by the exact institutions that need exactly that performance profile. Let me zoom out and give you the full picture, because I think the most important thing to understand about this moment is not any single announcement. It is what all of these announcements look like when you see them together. You have S&P Global, Fidelity, Franklin Templeton, and the DTCC all saying the same thing. Hundreds of trillions in assets are moving on-chain, and the infrastructure is being built right now. You have the OCC, the Fed, and the FDIC jointly removing the regulatory barrier that was keeping institutional capital on the sidelines. You have the DTCC filing patents that name Ripple's network explicitly in bridge routing architecture and adding Hidden Road to their back-end infrastructure. You have TCS Quartz Gateway, processing $40 trillion in securities annually across 100 countries, with Ripple mapped into the platform flowchart. You have Japan launching a live trade finance platform on the XRP ledger, targeting a market that moves $10 trillion per year, where even 1% capture equals 100 billion in annual ledger volume. You have Ripple acquiring G Treasury, which already processes 16 trillion in annual payment volumes. You have RLUSD ranking as the second most donated crypto asset in the world. Real utility, not speculation, demonstrating that regulated stablecoin infrastructure built on the XRP ledger is already operating in real-world financial contexts. You have Ripple valued at approximately $45 billion, ahead of Coinbase in some estimates. And I believe that number will exceed 100 billion as the full scope of these infrastructure positions becomes priced in by the market. And underneath all of it, you have an asset, XRP, with a fixed supply of 100 billion tokens, a transaction cost so low it barely registers, and settlement speed measured in 3 to 5 seconds that no legacy rail can match. The DTCC director said the winners have already been chosen. She said it in the context of explaining which blockchains they would partner with. She didn't name names, but the patents already did. Here is what I want to leave you with today. The price does not yet reflect what is being built. That gap between what the infrastructure diagrams already show and what the market currently prices is the opportunity. Not a speculative one, not a narrative one, a structural one. When the DTCC begins its tokenization service in the second half of this year and participants start moving assets onto blockchain rails through Hidden Road, the XRP ledger will be processing institutional settlement volume for the first time at a scale that has never been seen on the network. When Japan's trade finance platform scales and more institutions in more countries adopt XRPL escrow for settlement, transaction volume compounds. When MasterCard's RLUSD pilot moves from pilot to production, every card settlement that flows through that channel is a live transaction on the XRP ledger. When G Treasury's $16 trillion in annual payment flows begins integrating on-chain settlement capabilities, the number of wallets, the transaction count, and the demand for XRP as a bridge asset all increase simultaneously. None of this requires a prediction. It requires reading the infrastructure announcements that are already public, connecting the patents that are already filed, and understanding that the institutions building this do not wire systems into their architecture as a maybe. They wire in what they have already decided to use. The rewiring of Wall Street's plumbing is not coming. It is happening right now. The blueprints name the pipes, and one of those pipes runs directly through the XRP ledger. Comment blueprint below if you made it to the end of this one. I want to know who is actually reading the architecture, not just watching the price. If this is the kind of analysis that cuts through the noise for you, the subscribe button is right there. The next video is going to show you what happens to the XRP ledger's transaction volume when the DTCC's tokenization service goes live, and what that means for everyone who positioned before the mainstream connected these dots. Stay patient, stay rational. The structure is already in place. The capital just hasn't moved yet. We don't wait for the future, we plan for it.